Netflix just reported the most profitable quarter in its history. Net income surged 83% year over year to $5.28 billion. Revenue beat estimates. Subscriber numbers held. By every standard measure of corporate health, this was a triumph. And yet, by Friday afternoon, Netflix shares were down nearly 10%, one of the worst single-day drops of the year on a day when the S&P 500 hit an all-time high. That gap, record earnings, collapsing stock, is not an accident. It is the market telling you something about how Netflix is now being priced. The trigger was Q2 guidance. Netflix projected $12.57 billion in second quarter revenue, roughly $70 million below the Wall Street consensus of $12.64 billion. EPS guidance came in at 0.78, against an expected 0.84. On an absolute basis, these are small misses, but they landed at the worst possible moment, directly after a 50.
Netflix's business model has undergone a structural transformation over the past 2 years. The streaming wars are over. The company won. It now generates free cash flow at scale, has pricing power across its tier structure, and has diversified into advertising and live events. By those metrics, the 83% profit jump is real and defensible. The problem is that the market is no longer valuing Netflix on profitability. It is valuing Netflix on growth rate, specifically on the question of whether the advertising tier, the engine everyone expected to drive the next phase, is scaling as fast as the models assumed. Q2 guidance suggests it is not, or at least not fast enough. The $70 million revenue shortfall is almost entirely attributable to a slower ramp in ad-supported subscriber conversion. Netflix does not break out ad tier numbers in real time, which means analysts are pattern matching off guidance alone. When guidance is soft, the only thing they can do is cut targets, and cut they did, with Wolfe Research dropping to 107 and Barclays moving to 110. Morgan Stanley and JP Morgan pushed back the same day, both recommending investors buy the dip. Their argument, the guidance miss reflects a timing shift, not a trajectory collapse. The ad business is still growing, the content slate for Q3 is strong, and at the current multiple, Netflix is being priced as if the growth story is finished, which they argue it is not. That disagreement between the sellers and the buyers is the key structural tension here. Both sides have plausible cases. The question is which reading of Q2 guidance is correct.
The bear case rests on a specific premise, that Netflix's advertising tier is hitting a ceiling earlier than expected, and that the Q2 softness is structural, not seasonal. If Q3 revenue guidance, delivered with Q2 earnings in July, comes in below consensus again, the dip buyers will be wrong, and the stock has more room to fall toward the analyst cuts. The bull case requires only one thing, that Q3 guidance reaccelerates. Netflix's content calendar for the second half of 2026 is loaded. If ad-supported viewing hours hold up, and if the live event strategy, which management flagged as a growing driver, keeps converting casual viewers into paying subscribers, then Q2 will look in hindsight like a pause, not a peak. History provides a partial reference point. In early 2023, Netflix fell 9% on Q4 guidance, then recovered all of it within 6 weeks as Q1 numbers came in ahead of expectations. The strategy: great actual results, soft forward guidance, sharp single-day repricing. The difference this time is that Hastings' departure adds an uncertainty premium that was not present in 2023. Sentiment recoveries tend to be slower when they require a trust rebuild, not just a number. The benchmark to watch is the Q2 earnings call in July, specifically whether Netflix discloses ad tier subscriber numbers voluntarily, and whether Q3 revenue guidance clears $13 billion. If it does, Friday's draft looks like an entry point. If it does not, the 83% profit figure will be remembered as the moment earnings stopped being the metric that mattered.